Welcome to the Income Bridge, tax-efficient equity unwinding for early retirement. In this video, we will explore how to fund the period before you can access retirement accounts without triggering unnecessary taxes. We will focus on controlling realized capital gains by using deliberate, manual strategies, especially the specific ID method for tax lot selection. We will also discuss why retail automation often falls short and how to use brokerage tools effectively. Here is our agenda. First, we will define the income bridge and why it matters. Then, we will cover capital gains tax basics to set the foundation. Next, we will dive into the specific ID method and why it is so powerful. After that, we will walk through practical brokerage execution. We will then examine AGI control levers. We will use a mini case study to make concepts concrete. Finally, we will test your knowledge with quizzes and wrap up with key takeaways. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Everyone's situation is different. Before acting, verify current IRS rules, thresholds, and your brokerage's features, and consult a qualified professional. The income bridge is the period in early retirement before penalty-free access to retirement accounts, when you must pay your living expenses from other sources. Typically, this involves selling assets in a taxable brokerage account. The challenge is to free up cash while minimizing taxes, which requires careful selection of which shares to sell. The income bridge is not primarily a software problem. It is a strategy and execution problem. To navigate taxes, remember that gains are taxed based on how long you held the asset. Less than 1 year is short-term and is usually taxed at ordinary income rates. 1 year or more qualifies for long-term capital gains rates, which for many households can be 0 or 15%. Your actual rate depends on your taxable income and adjusted gross income, because these determine your bracket thresholds. Also, dividends and other income stack on top of gains, so the timing of sales matters. You can harvest losses to offset gains and improve future flexibility by resetting cost basis. This flowchart shows the end-to-end execution process. Start by determining the annual cash need. Then review taxable holdings and filter for long-term lots to benefit from the lower long-term capital gains rates. Next, rank lots by the smallest unrealized gains or by losses. Use specific ID selection to choose those lots deliberately. Execute the sale, and then rebalance the portfolio back to the target allocation. Log the realized gains or losses, and update your adjusted gross income projection. If you still have room in your desired bracket, you may realize additional gains deliberately. Otherwise, stop and reassess later. Here is the practical sequence. First, ensure your account's cost basis method is set to specific ID. Next, list all tax lots for the security you intend to sell. Sort or filter lots by the lowest unrealized gains or losses if available. Select exactly those lots for the sell order, verifying share counts and long-term holding periods. Preview the order to estimate realized gains and confirm the holding period. Place the order and record documentation, such as a screenshot or exported trade details. Update your realized gains tracker and your AGI projection. Finally, rebalance and verify that you remain in your desired tax bracket before placing any additional orders. Most brokerages allow per-lot selection within the trade ticket when specific ID is set. Use columns that display unrealized gains or losses and the lot holding period so you can avoid short-term lots. Export realized gains reports to keep your records current or share with your tax preparer. Consider enabling alerts or reviewing wash sale indicators to avoid inadvertently disallowing losses or altering basis. This conceptual table explains how long-term capital gains brackets work without relying on year-specific thresholds. The lowest bracket can allow 0% taxation if your taxable income remains within that band. The middle bracket is 15% for many households. At the highest bracket, the rate is 20%, and, depending on circumstances, the net investment income tax can apply. Always check the current IRS thresholds for your filing status each year. This mind map outlines the major levers you can use to control adjusted gross income. Manage income streams, such as long-term gains, short-term gains, dividends, and Roth conversions. Combine them with offsets including harvested losses, above-the-line deductions, health savings account contributions, and charitable approaches. Use timing by doing early year sales for visibility, or batching near year-end, while avoiding wash sale violations. Lastly, make thoughtful account choices, typically tapping taxable accounts first, preserving Roth accounts, and deferring traditional IRA withdrawals when possible. On the left is the manual strategy, which gives precise control over tax lot selection using specific ID. It enables transparent management of adjusted gross income and can be aligned with your goals and risk tolerance using tools available at most brokerages. On the right is automation. Retail-grade tools generally do not optimize exact lot selection and can misestimate tax impact or adjusted gross income. They may overlook wash sales, timing considerations, or your spending plan. Automation can be helpful for tracking, but it is not a substitute for deliberate lot-by-lot decisions. Quiz time. The question is, which action best minimizes your realized capital gains when funding the income bridge? Option A. Selling lots with the largest gains to lock them in. Option B. Using FIFO because it is simpler. Option C. Specifically identifying and selling lots with the smallest gains or losses. Option D. Selling short-term lots first for faster turnover. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is specifically identifying and selling lots with the smallest gains or losses. This approach reduces realized gains and helps you stay within favorable long-term capital gains brackets. Second quiz. The question is, why is relying solely on retail automation risky for lot selection? Option A. It guarantees higher taxes by design. Option B. It may not optimize exact lots and can misjudge the impact on adjusted gross income. Option C. It is illegal for individual investors. Option D. It can only handle mutual funds, not exchange-traded funds or stocks. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that automation may not optimize exact lots and can misjudge the impact on adjusted gross income. While automation can assist with tracking, it often does not execute the per-lot precision needed for effective tax management. In this mini-case, the goal is to raise $40,000 in cash while staying in a favorable long-term capital gains bracket. The approach is to sell long-term lots with minimal gains using specific ID. After previewing the order, the estimated realized long-term gains are approximately $3,200. Once you log the realized gain and update your adjusted gross income tracker, you confirm that you remain within the desired bracket. After executing the sale, you rebalance and then evaluate whether you have room for any Roth conversions. This pie chart shows a hypothetical funding mix for an income bridge year. In this example, 60% comes from selling exchange-traded fund positions, 25% from an existing cash buffer, 10% from dividends, and 5% from side income. Your mix will vary by portfolio, risk tolerance, and market conditions. Here are the key takeaways. First, specific ID is the most important lever for minimizing realized gains. Second, manual lot selection gives you control over adjusted gross income and tax brackets. Third, automation is helpful for tracking but not for making final lot decisions. Finally, document your actions, rebalance, and iterate throughout the year as your needs and markets evolve. To conclude, determine your cash need first and plan your sales deliberately. Prioritize long-term lots with the smallest gains using specific ID. Track realized gains and adjusted gross income to remain within your target bracket. Use your brokerage's tools effectively and avoid over-reliance on retail automation. Rebalance and repeat as market conditions and spending needs change. Thank you for watching. If you found this helpful, please like, share, and subscribe. I would love to hear your bridge plan in the comments and what topics you would like to see next.